residential real estate is very elastic to supply and demand. And so, the higher inflation justifies the higher cost to bring on new product typically. And then the kind of supply and demand dynamics where we have more demand than we have supply of homes, right, is what's driving rental prices higher. But I don't think that's like if this persists for a long period of time, it's not going to be healthy for society. Right?
Mm-hmm.
Like too much inflation over a short period of time, without the commensurate rise in incomes, it ends up causing a problem for society. Right?
Hi, everyone. Welcome back to the Investipal Podcast. My name is Cam. I'm welcome today with Stavro. Stavro is the CEO of NexLiving Communities, a multifamily real estate company focused in on the 55 plus age demographic, primarily focused in on Eastern Canada and Ontario. Stavro, welcome to one of the Investipal Podcast.
Thanks, Cam. Thanks for having me. This is great.
So, you and I, I got my start at CIBC with you there. I know you and I spoke quite a bit about real estate. You're now the CEO of a publicly traded real estate company. There's been lots of focus, especially in Canada, around immigration, house prices becoming out of touch for the everyday Canadian. I'm curious your opinion on the Canadian housing market, and if you think immigration versus interest rates is going to change prices up anytime soon.
You're right. This is a big topic for people today, right? And so what's happened, if you would have gone back 5 years ago, right before this interest rate hike, I would have thought that home prices were more inflated then than they are today. And the reason for that is, if we're looking at residential home prices, is the cost to construct these homes has continued to climb up. As we're seeing a lot of inflation in the system. Right. So bringing on new homes, whether the cost, part of the cost is, if you think about it, it's not just the material and the labor that goes into building a home, but it's the period of construction that has interest rate, typically financed by debt. Right. So that those interest rates go up. The other thing is in commercial construction, right? The lenders are requiring higher equity checks and higher contingencies, right? So the amount of capital that you need to start a project has really ballooned, and then the cost to bring it on has really ballooned. And so you look at where existing home prices are transacting today relative to their replacement costs, that spread has narrowed, right? So I actually don't find that we are in a highly inflated environment right now.
Oh, really? So do you think is there other work that could be done to help bring in house prices or help bring in like new developments? Like I saw, was it the Ontario government or the federal government that waived HST on new rental properties?
That was a big change for a developer, because if you think about it, what was happening historically was, let's say it costs you $15 million to construct an apartment building, right? You would pay HST and GST and all your trades and all your materials, and then at the end, the building might get appraised, and the government might take a view that building is not worth 15, it's worth $20 million as builded value. And then you would pay additional HST on the $20 million valuation. Right. So this, and in many cases, like the equity margins, really healthy developer margin would be 15%. Right. So you're talking about taking away half the profits in some cases. Right. And so with that gone away, you'll see that more capital is going to be directed towards development of homes. So that's one thing. Supply. We're talking about supply here, right? But I want to step back on what I was saying in terms of like home prices. You can buy a built in the last 10 years, kind of like family home, 3-bedroom, 2-bath, detached with a garage and a decent sized lot with a backyard where your kids can be on the slide, for, in most parts of the country, for under $500,000, right? And so to me, that's not a that is not, well, it's not the most affordable price, right? I don't think the cost to construct that would not be that far from there. So maybe a developer's building it for 450, right? It's coming online, right? And so, yeah, there's certain parts of the country where, there's a huge demand for real estate. It's downtown Vancouver, downtown Toronto come to mind, right? And those areas are actually what we've seen versus historically is we've seen that we now have relief valves, right? So there's like people have the ability to not live in downtown Toronto, but still earn income for that from that downtown Toronto or downtown Vancouver job, right? And so I think that has allowed to moderate the supply and demand. But, the industry and the government and society has to come with a response because we have a very positive immigration story in Canada. And the response has to be we have to build more homes because the worst thing that could happen is right now, Canada, I like to say, like, I'm an immigrant, right? My family immigrated here. I grew up in Greece, so I moved to Canada, right? So I understand the immigration story in Canada. And yeah, I still think that it's a really good place to immigrate globally, right? Like, we're the world's safe house. No matter what's happening in your country, you can come to Canada, put your head down, work really hard. You and I, investing nerds, we talk about, investing our capital and the money we earn in a smart way, right? And I think that if you can do that, you still can have a very good life in Canada. That's great. So immigration is generally a positive story in Canada, but if we don't keep,
though, like on that note, like, I moved out east for a little bit.
Mm-hmm.
I found that, Canada doesn't have a lot of metropolitan areas like the US does. Like the US,
Mm-hmm.
You could get a banking job, you could get the same sort of career you have in a multitude of different cities. In Canada, it seems like it's very segmented around the GTA, to a lesser degree, the Greater Vancouver area, and then Montreal kind of third on the list. But there's not a ton of, there's not the same quality or the same level of income outside of some of these three major cities in Canada that, while like housing prices could be lower, the ability to have a job in those other cities like St. John is really there.
Yeah. So look, the cycle of life of someone's life, they start at university, they come out of into their careers, right? And they want to be in places where there's a lot of other young people in training for their job and the opportunity to collide with senior people and get that guidance and mentorship, right? And so that's why these large centers are very attractive, right? And people will pile up, 3-4 roommates into an apartment to live in. And that's a great part when you're starting your career. And then the next phase of life is when you start having kids and an angry wife or husband, and you need some space. You need a basement for all the stuff that comes along with kids. And then, so you have the opportunity to then, you don't have to live downtown, but you can move kind of suburban life or even further away and commute into your city. But think about, let's say you're 55, kids are out of the house, and you still have that job at like one of the big banks or in a law firm or as an architect or, but you have your contacts, you have your network, you have your reputation. I just went to a retirement party yesterday for a friend of mine who is in his late 50s, and he, has moved to BC. He was in Toronto, his whole career, right? So his retirement party, he now lives in BC, but his retirement party was 100 people in Toronto because that's where his whole network was.
Right.
And he's living in Whistler full time, right? And he's 55, right? And so that guy's going to live till he's 95, right? That person wouldn't have had this opportunity to leave and still maintain that job, right? And he retired and changed his career as well, but he could have stayed in his previous role and worked out of BC, Whistler, right, and enjoyed life, right? So that's what I'm saying. It doesn't work for everyone, right? Cam, like you went out to Halifax, right? And yeah, I also went out to Vancouver when I was 25, and I'm like, well, this is sleepy. Right now, I would, probably, with kids and close to the mountains and skiing and all that, it would be a fantastic place to live. So there's, a different phase of life. I have my view is that there is more opportunity for people to do this, right? It's not for everyone, but because there is more, we will have more people working remotely, working from places where it's a more affordable, better quality of living, right?
I would love to see that future. I guess the way I think of it is, Canada's very accommodative on the immigration side. Where do a lot of those immigrants end up? They end up in these metropolitan areas with
Hmm.
their like-minded communities. Like, you probably chose, and your family chose Greece or Toronto to settle because there's an existing Greek population here, and you didn't choose like Halifax, for instance,
Hmm.
because of that. I don't know. Was that sort of the line of thinking on why your family decided to settle in Toronto?
Yeah. So actually, my family I grew up in Calgary, so that's where my family settled.
Oh, okay.
Right. Yeah. Yeah. So that and there's a big Greek community in Calgary. So you're right. That was the problem because that's what happens, right? The immigrants move here and then they bring their family and friends and
Yeah.
they settle. But our properties and our company are primarily in Atlantic, Canada, and I go to some of these communities. Like I go to Moncton and I talk to one of our board members who's lived his whole life in Moncton, and he, you'll be walk like, first of all, with 100% hit rate, you talk to any barista or bartender and they're from somewhere else,
Right.
right? And then because these are the people I might have a conversation with, right? And then we'll be having lunch on a patio and there'll be like a group of you know you know you'll see a group of like four black kids running beside you, and he like you'll turn around to me and be like, that you didn't see that 5 years ago, that didn't exist, right?
Right.
Or we've driven through communities and there's like entire like parts of the city that have become more, pick your group of immigrants, because the largest group of immigrants in Canada today are the Filipino community, um, and India, Pakistan, right? So those are the two big proportions. You'll see those communities starting to you know lay roots in all these other in secondary, tertiary markets in Canada. So you're right. Everywhere else in the world, this is pretty normal though, right? This is pretty normal. It's pretty normal. Like if you have a job in Amsterdam, if you're from Amsterdam and there's jobs in Rotterdam, you get up and go. Right? This is not like this is a pretty normal thing in developed countries and not
Just
developed
not
countries.
here to the same degree. Like it
Yeah.
seems like where you grew up is like where you continue to live when you get older. There's not a lot of
Hmm.
moving around within the country.
Yeah, that was the contract in Canada for a long time, right? You
Yeah.
could, as long as you worked hard, you could get to live on the same street you grew up on, right?
So do you see? So I guess to this point, then you still see immigration as like a driving force to keep house prices, to keep rental rates quite elevated, despite the elevated interest rate environment that we're in right now.
I think it's look, there's inflation in the system, right? And with inflation in the system, the price of your groceries go up, right? Price of labor goes up, price of building materials goes up, and there are hard assets that have pricing power. And multifamily historically has been very elastic and very to demand, right? So multifamily and just residential real estate is very elastic to supply and demand, and so the higher inflation justifies the higher cost to bring on new product typically, and then the kind of supply and demand dynamics where we have more demand than we have supply of homes, right? Is what's driving rental prices higher. But I don't think that's like if this persists for a long period of time, it's not going to be healthy for society. Right? Like
Hmm.
too much inflation over a short period of time, without the commensurate rise in incomes, it ends up causing a problem for society, right? But right now it's a very healthy operating environment.
So, I rewind a few years ago. Um, the way to get rich in Canada was to own real estate and to leverage up your current assets to buy more with. I don't know if that was the same sort of model that the likes of like Next Community would be operating under, but has there been a big shift in, I where I'm going with this, it seems like a lot of those, part-time real estate developers, like doing this as a side job, a lot of those guys ended up getting burned with a higher interest rate environment. Is this requiring you to rethink how you run your business?
We were, Cam, at Next Living, we were always set up. Our model was always to do invest in markets that has this. We thought the way we looked at it is that it's similar type of risk as core markets, but with much higher returns. And those higher returns give you a buffer, They give you a buffer where when things go bad, you have a lot more cash flow in the company to withstand. So we were always set up for that. Absolutely, when we have refinance mortgages that were at 1.25% with 4.25% mortgages, right? So that's a very big change, right? When the biggest cost of your asset is triples, right? That's a very big change. But I guess your question is, has it changed the way we run our model? Well, we're much more, obviously the value of your capital is higher today, right? Because you usually deploy at much better returns, right? So you want to be a lot more careful. But with respect to, and we're being a lot more thoughtful around the cost side of our business, and making sure we price our units properly, right? We're not being lazy with anything, right? I think we have to be a lot more, make sure that we're protecting the cash flow right now, which again, it's a very healthy environment for multifamily. And the reason is, you have this, one of the things is that your entire portfolio of debt doesn't get repriced day one, right? So you have time, if you have a well-structured and well-laddered debt maturity portfolio, you have time to, as these mortgages get priced higher across your portfolio, you have time to make moves that offset the kind of the cash flow drag that comes from the higher interest rates. And so far, that wedge of cash flow has been growing, right? So,
is there any change to how you what's the current OpEx? Are you guys at an 80% loan to value right now? Or are you looking to reduce that? Are you looking to increase it in a larger interest rate environment?
Sometimes I have this conversation. So I think I look at that as, so my background, I worked in restructuring for a few years, right? I've seen during the credit crisis, I've seen things go bad. And you think about debt, you can think about how much debt you have on your assets, the price of that debt, and the structure of that debt. So those are the three things that really matter. And you might take higher price for the better structure, or you might put more debt on if you get the right price on your assets. And you thinking, so we have primarily on our mortgages, on our properties, we have mortgages that are CMHC insured, 5 or 10 year tenor. And they'll have 40, 50-year amortization in many cases, right? And what the CMHC insurance wrapper on your mortgage, what it means is that you have counterparties who will provide lending, but they'll have a government guarantee that they get the return of their capital back, right? And so if for some reason a borrower were to go bankrupt or not be able to satisfy the debt payments, they would, CMHC would take the keys of the building, and then they would be able to, the lender would not get impacted, but then they would find a home for that, right? And that's kind of the story of a lot of these REITs, right? A lot of these REITs today, they started with taking the keys from CMHC. Great opportunity. If that happens again, you might see me quit my job as CEO of Next and just go do it myself, or we'll probably just do it in Next, right? But I mean, it would be a great opportunity to buy assets at half the value of construction, right? That are brand new because people. But I do think that that time might come, right? There was when I didn't really understand it, when you look at the last couple of years, people were developing to kind of a 4 yield or buying assets with a 3%, a 3 handle on their cap rate, right? And then financing with a 2 and saying, hey, look, there's spread. But 5 years later, that 2 is becoming a 4% or a 5% mortgage. You better have double the cash flow. So you have 6% yielding on your cost, right, to be able to refinance the same mortgage amount, right? And so I don't think that's happened. And I think that there's going to be a lot of these trophy assets that are going to start hitting the market. And so I do think there is going to be an opportunity. There's going to be. I don't think we've seen that we haven't seen that yet in the market. And when those assets come, I don't know if NexLiving is going to focus on trophy quality assets. I think we're more cash flow focused at our company, right? But I think there'll be opportunity to.
I mean, everyone wants a trophy wife, so makes sense.
Yeah.
What part of the market is it? Is it single family homes that fit that bill, or is it on the corporate side at all?
So yeah, like I think, I mean, we're focused on multifamily real estate, so
Yeah.
I spent all my time reading about that. Right? There's obviously right now there's a scenario that this is happening in the office market, right? So you see, we've seen like articles where Brookfield's handing over the keys to the lenders. They're going to be on the back end bidding for it to buy it at below replacement cost, right? So you see, there's articles of office buildings that sold for $1 billion in San Francisco, selling for 200 million. So that's 80% mark to market lower, right? So that's happening in office. In multifamily, um, in Canada, multifamily again, we have this very strong supply demand dynamic, right? And we talked about how these assets have pricing power as a result of that, and we also have 1 year leases that get to renew higher. And yeah, there could be rent controls, but typically when a tenant leaves, then you can put a market price on that unit that gets relieved, and that allows you to spend your capital and all those sorts of things, right? So I think we haven't seen that yet, right? We haven't seen distress selling, but I can imagine if I was a developer, right? From the first day you you put the shovel in the ground or you're getting your permits, right, till the day you receive your first rent check, it's often 4 or 5 years,
Right.
right? And so you're always, by definition, bringing an asset into a way different market than when you started it. For the last 30 years, it's been a better market, right? So you had a positive surprise that you started collecting the rent, right? But now, yeah, rents are higher, but to that period of construction, your costs were way offline, right? And your your takeout financing is going to be a lot more expensive than you thought. And so I think that's where we're going to see the first signs of pain.
Interesting. Okay. And then in terms of like the best areas of opportunities that you guys are focused in on, it's primarily East Coast, right? Like you're not seeing as much. It's not as lucrative on the in Central Canada, Western Canada.
I wouldn't say that. I think Alberta is doing fantastic right now. I mean, we looked at a portfolio going almost 18 months ago in Alberta that could have given us some scale there, but ultimately we decided to invest in East Coast because I think we thought getting more scale would drive our costs lower, so we made that decision. It's been both were good. I think we originally 2 years ago when I joined NexLiving, if you and I would have spoken, I would have said, "Hey, look, these markets are getting way more population growth than the rest of the country." That's still the case, but we're now seeing rents going up across the country, right? So
Yeah.
like, there's a lot of really good markets right now. So I think the risk in multifamily historically has been your exposure to one political decision, right? So over time, you want to diversify, right? And the sun is shining in New Brunswick right now, and I think it's going to go great. But I know if over the period, like I just know intuitively over the period of 10, 15 years, it's going to be a point where we're going to have some dark days for whatever reason, right? So you want to always have some diversification over the long term because the regulatory impact could be significant, right? Somebody makes a decision that's not well thought out, and then you're on your heels for 5 years, right? And so
Yeah, I'm interested to see because like when I moved out east, house prices were just starting to pop up,
mhm.
and there was advertisements being run by the provincial governments to relocate out east. To your point, you can work remotely, so why not work from here? And it's
Yeah,
definitely a lot more scenic than Toronto is.
yeah.
They have their other issues they have to battle with infrastructure mainly, but it definitely does seem like we the parts outside of these major hubs like the GVA, the GTA, are actually starting to put some thought into how do we attract people outside of like the resource industry. Like Calgary's obviously taken off quite a bit as well, and
Yeah.
it's not because of oil and gas. It's because of like their growing tech scene and no provincial income tax as well definitely helps.
Calgary's a great place to live. Like, you got more engineering degrees and more just generally university degrees per capita than any other city in North America. They're the top of all North American cities on a proportion basis, right? You got the mountains right there, right? Skiing, national parks, right? Like, world global destinations for outdoor activities, right? It's an affordable place to live, and you're right, taxes are lower, and there's empty vacant office space, right? Because like so you get like cheap office rents if you want to start up a company, right? So that's a really good environment to start, right? So Calgary is really good, and I think that if a little bit of competition for that immigration. I mean, look, Canada doesn't really have to compete for immigrants globally. We get more immigrants per capita and the better immigrants, because typically, when I say the better immigrants, the ones that are, have more capital or better skill sets, right? And because no one really arrives in a raft in Canada. Like, I know it's not the most politically correct term, but people have to jump on a 747 here to get here, and typically, so we get a good demographic of immigration, right? And we don't really compete intra Canada. Toronto never really had to compete, and Vancouver didn't have to compete for immigration. But now a little bit of competition is not a bad thing.
Yep.
Right. It means that the regions of the country that get it and do the right investments, make the right investments, because you need schools, you need hospitals, you need homes. Right. Those are the basic kind of like services that you need to make sure we'll get a bigger tax base, and the profits will do better. Right. Or the area, the region will do better. Right. So.
Yeah, absolutely. So I guess, on that note, and we haven't really spoken about NexLiving at all. How are you thinking about NexLiving and the evolution of the company over the next 5 years?
I think, so we're still a tiny company, right? We're about 1,200 units. The average age of our unit is 7 years old. Average square footage, 1,000 square feet. They're all nicely appointed. They look, sure, if you turn the camera in your place, they look the same. Like they got hardwood floors, stainless steel appliances, stone countertops, really nice views. Very very spacious units, right? Usually an elevator bank. There's a common room area, gym. There's a pool. There might be a golf simulator in one of them. So there's like activities for people. They're beside a golf course. So these are really nice residences. Typically, when you go there, you're like, yeah, I could see myself living here. Very nice community. And we focus primarily on these mid cap buildings. Right, so they're not the sky-rise buildings. So typically, there's a community. So think 50 units, 70 units, right? So nice community. Some of them are they just naturally populate with people who are renters by choice, right? So it's another way of saying. So a lot of times we get the downsizer community, people who want the lock and leave lifestyle, maybe spend 3 months a year at their cottage or 3 months a year in Florida or somewhere warm, and so that we get a lot of those renters, right? And that's our niche, right? From my perspective, I still think that New Brunswick is a very Moncton is now 30 years straight the highest growing population city in Canada, right? So when I think when I first joined NexLiving, population in New Brunswick was 750. Now we're at 827 or 825, right? It's going to 1 million. Right. And so there's, our assets are valuable because these are residences for all this, for these populations. So oftentimes what we see is a tenant has sold their home to usually someone from Ontario, and then they move into our units. And that's typically what's happened. Right. And homes there are still very affordable. Right. So that's typically the nature of what we're doing. I think we were at a good scale for New Brunswick. We'll continue to grow. I think there's a really good opportunity there. We have a really good pipeline of acquisition opportunities there. We have capital getting released from our portfolio. So that's an opportunity, and I think that we have a view that we want to diversify away, but we only do it in a way that's really highly accretive to our existing shareholders. It would have to come with some scale in that region. Right, that it had to be kind of like 400 units or more for any real shift to another province, and so we're looking at those kind of transactions as well.
So more probably more West Coast based, or would you look towards like a Ontario, Quebec?
I like Alberta, but I think it would be easier to manage a portfolio that's still kind of central East Canada. From at our stage of the company right now, right, notwithstanding my bias to, I think it's a really good operating environment in Alberta, right? I do think that, just from like, we already have 3 buildings on Ontario, right? So that's natural to us, right? That I would probably see us focus on there first.
Would it be more within like a retirement focus? Like instead of looking at like the GTA, be looking at like Collingwood or like looking at like Muskoka?
Look, it's exactly, so we don't, our buildings are just like any other apartment building, right? They're just usually nicer. There's more common areas, right? They're bigger units. We have units that are accessible, right? But there's no real operating model on top of that. Like we're not an independent living facility or anything like that. But if you think about where people want to live, you're not going to see us buying in downtown Toronto, right? But you might see us look at Barrie, or you might see us look at, our building is in Lindsay, which is right at the base of the Kawarthas, right? We have another building in London, Strathroy, Ontario, right? So Southwest Canada, right? And we have a building in Oshawa, right? So those are typically the markets where we see more value, better return on cash flow, kind of the same. Another way to think about it is you don't need to underwrite extremely high rents to make the numbers work, right?
Right. And do you guys find are you, especially on the East Coast where there's not as much rent control in place, are your rents on par with the provincial averages? Are you below? Are you above with like some of the amenities you're able to offer?
Well, it depends. It depends. So Alberta is the largest non-rent control province, and then the second largest is New Brunswick. So we're there, right? But here's the thing, right? If you look at like long term, really what drives the pricing of rental demand is not whether it's rent control or not. It's because they actually follow the same line. It's actually supply and demand, right? So that's really what drives it. So I guess your question your question was if would we focus on New Brunswick or
how your rents were priced relative to the averages?
It depends. So we average unit in our portfolio is around 1,000 square feet, and the average rent is around $1,350. So that's $1.35 per foot if you wanted to use that metric. The average rent per foot in Toronto today would be $4.50 per foot. Right, the average CMHC. I spoke to one of their economists there, and he doesn't see anything sub $2 a foot in Canada anymore. The numbers don't work, right? So $1.35 a foot is a very affordable. So think about 1,000 square foot unit. You got 2 walk-in closets, 2 bedrooms. This 1,000 square feet is a spacious unit. Most of our 1 bedrooms are 900 square feet, and our 2 bedrooms would be 1,200 square feet, right? So think about that. Would be so a 2 bedroom at 1,200 square feet might be priced at $1,600, right? 1,200 square feet, which is the size of a small home in Ontario, right? So it's a really these are very large, spacious units, right? And it's a pretty affordable rent.
Yeah, and I guess
you're asking like the average rent. The average rent. On average, our buildings are way newer, way nicer. So in some markets, we screen higher, right? But when I compare those to, like if I compare one of our buildings that we've owned for kind of 4 years to one that's coming on right now, the rents in that one coming on right now could be 20 or even in some cases 30% higher.
Right.
The cost to construct is 20 to 30% higher.
So you guys would end up having quite a bit of wiggle room there to increase rents, I guess, based off of at least the Canadian average.
Yeah, we don't get the turnover that everybody else gets, and that tells you a lot, right? Like we get single digit turnover, like maybe we get to 10%, right? The national average is 25, right? Which tells you that people feel very good in our buildings, right? They feel like they are either getting very good value, right, for living in there, right? And so that's one of the metrics that you could look at.
Huh. Well, maybe with next time I see you, you might have a little bit more gray hair. Maybe you'll be a tenant of your own company soon.
That would be the dream, the lock and leave. It probably means I'm golfing a lot more.
That's a good sign too. All right, Stav. Maybe we'll leave it there. If anyone is interested in learning more about NexLiving, we'll leave some information in the show notes. Hopefully, we can chat a little bit more about the real estate market. Especially the Canadian real estate market in a few months from now.
Sounds good.
All right, Steph. Thank you.